Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Fox Corporation Quarterly Report. Fox Corporation offers a diverse range of businesses and services across 4 key segments. The cable network programming segment produces and licenses news and sports content for various platforms, including traditional cable television systems and digital platforms. The television segment is responsible for producing, acquiring, marketing, and distributing programming through the Fox broadcast network, as well as operating full-power broadcast television stations and providing content to third parties. This segment also includes the advertising-supported video-on-demand service Tubi. In addition to these segments, Fox Corporation engages in consumer finance through its Credible segment. The company's Fox Studio Lot segment provides a range of services, including television and film production, office space, studio operation services, and facility operations. Overall, Fox Corporation offers a comprehensive suite of businesses and services that cater to the news, sports, entertainment, and financial needs of consumers in the United States. Fox Corporation's stock price has experienced a significant increase of over 24% in the past year, with its Class A shares rising by 39.62% and Class B shares by 26.63%. This appreciation can be attributed to several key news events and strong business performance throughout the year. One major factor contributing to this growth is Fox's robust financial results for the second quarter of fiscal year 2026. The company reported a 2% increase in total revenues, surpassing analyst estimates, with adjusted earnings per share exceeding forecasts by a significant margin. This positive earnings beat indicates the company's solid operational execution. Additionally, Fox's revenue growth was fueled by a 5% increase in distribution revenues within its cable network programming segment and a 1% increase in advertising revenues, attributed to higher pricing in sports and news, as well as continued digital growth from the ad-supported streaming service Tubi. The strong performance of Fox Sports, which maintained its leadership in live sports event viewing, also contributed to sustained engagement and advertising appeal throughout 2025. The company's aggressive share repurchase programs, totaling $1.55 billion during the second fiscal quarter of 2026, demonstrate confidence in its valuation and can positively impact stock prices by reducing the number of outstanding shares. Furthermore, Fox's positive future outlook, driven by upcoming events such as the 2026 FIFA Men's World Cup and the U.S. midterm elections, likely contributed to investor optimism over the past year. Overall, these factors have combined to drive Fox Corporation's stock price increase in the past year, making it an attractive investment opportunity for investors seeking strong returns. Fox Corporation maintains a market capitalization of $29 billion, broadly in line with the industry peer group. Fox Corporation trades at a higher price-to-earnings ratio of 16 times and a higher price-to-book ratio of 2.64 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. Investor should evaluate if the stock is worth its premium price. The company maintains a moderate leverage profile, with liabilities making up 47% of total assets, suggesting a balanced approach between risk management and capital efficiency. Average liabilities have increased over the past 5 years, which is normal for a growing company. Asset and equity growth have outpaced liabilities, suggesting balanced and healthy expansion. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. The company has aggressively reduced its share count by more than 5%, while revenue, profits, and assets have grown. This represents a very favorable capital allocation strategy, with management materially increasing per-share value. The income statement shows that the company have been growing its revenue annually, and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth or decline can be identified through a review of key industry sectors. In terms of revenue growth, the cable network programming sector has been a significant contributor, with distribution revenue increasing by 5%, advertising revenue rising by 7%, and content and other revenue growing by 4%. The corporate and other segment has also experienced substantial growth, with a 114.5% increase over 3 months and a 73.9% rise over 6 months. In contrast, the television sector has seen some decline in certain areas. Specifically, content and other revenues have decreased by 19%, while eliminated other revenue has dropped by 45% over 3 months and 38% over 6 months. These figures suggest that while some sectors are experiencing growth, others are facing challenges that may impact overall revenue performance. The net income and profit margins of the company experienced significant declines in the 3 and 6 months periods ending December 31, 2025. For the 3-month period, net income decreased by $141 million, representing a 36% drop from the previous year. This decline was accompanied by a decrease in net income margin from 7.6% to 4.8%. Similarly, for the 6-month period, net income plummeted by $364 million, marking a 30% reduction. The adjusted EBITDA as a percentage of revenues also saw a decline, dropping from 15.3% to 13.3% in the 3 months, and from 21.2% to 20% in the 6 months. These decreases indicate that the company's profitability has been impacted by various factors, resulting in lower net income and profit margins. The significant drop in net income margin suggests that the company is struggling to maintain its pricing power or control costs effectively. Management is signaling a significant shift in the company's strategy, prioritizing digital growth over traditional broadcasting. This pivot involves investing heavily in digital content costs, sports programming rights amortization, and production expenses to drive expansion. However, management acknowledges that benefits from recent acquisitions may not materialize as expected. Furthermore, the company must navigate challenges such as renewing programming rights on favorable terms and adhering to evolving laws and regulations related to data protection. The acquisitions and divestitures made by the company are significant events that have shaped its business landscape. On the acquisition front, the company has been involved in a combination or significant acquisition involving itself, as mentioned on page 39 of the summary. In terms of divestitures, 2 notable transactions stand out. Firstly, in June 2013, 21st Century Fox, Inc., 21CF, and News Corporation were separated, marking a significant move by the company to restructure its business operations. Secondly, the company has disposed of various assets, including reporting units, indefinite-lived intangible assets, investments, or long-lived assets, as mentioned on page 39. These acquisitions and divestitures demonstrate the company's strategic efforts to adapt to changing market conditions and optimize its business portfolio. The company has a history of rewarding its shareholders through various means. One way it has done this is by paying dividends to its investors. In fact, the company has declared semi-annual dividends in the past, with the most recent one being $0.28 per share for both Class A and B common stock. In addition to paying dividends, the company has also been active in buying back shares from the market. This strategic move aims to increase shareholder value by reducing the number of outstanding shares and thereby increasing earnings per share. The company has made significant purchases in this regard, with one notable instance being the repurchase of approximately 25 million shares for $1.8 billion. The report highlights 2 significant concerns that warrant attention. Firstly, there is a growing concern about inventory buildup. The data shows a substantial increase in inventory levels from -431 in 2024 to -937 in 2025. This trend suggests that the company may be accumulating excess stock, which could lead to storage costs and potential losses if not managed properly. Furthermore, the report also mentions supply chain disruption as another area of concern. The potential disruptions mentioned include failure to enter into or renew affiliation agreements, damage to the company's brands or reputation, and labor disputes involving professional sports leagues. These risks have the potential to severely impact the company's operations and bottom line if not addressed promptly. That concludes the financial summary for Fox Corporation. Feel free to comment below, and I will be happy to answer them when possible.